how, if we are looking to insure the Bitcoin, how can we make it more robust to loss, damages, theft, any other asset, fine art, gold, collectibles, anything else would have an insurance market. And the idea ultimately with insurance is that you come to an agreement with someone and that in the event something goes wrong, they'll be able to step in and indemnify you. This was much more directly akin to a bar of gold. I have a coin. It has information on it. It needs to be safe and not destroyed. So you're kind of like locking it away in a traditional vault, right? Because you're still dealing with like a physical token. We leverage multi-sigs of multi-sigs. So actually for the length of your insurance contract, AnchorWatch is a required cosigner. It's an interesting concept too, because at no point ever can the money be moved by AnchorWatch by ourselves. Basically, any individual who's self-custodying, what they're doing is called self-insuring. And all that means is that you bear all the risk.
We can directly start into with Bitcoin insurances a little bit, because I think that's a topic that is rarely discussed on any on any podcast. It's also something that's pretty new. So that's what you're currently focused on with AnchorWatch and yourself, as I understood it.
Yeah. Absolutely. Yeah. So the base premise, AnchorWatch is coming up on 3 years old. The initial premise was ultimately the way Bitcoin is kind of managed today. You think about it in the sense of risk management. You have, and that it relates with insurance. The way Bitcoin really works today is if you're an individual, basically any individual who's self-custodying, what they're doing is called self-insuring. And all that means is that you bear all the risk. If something goes wrong, there's no refunds in Bitcoin. If something gets mismanaged, you lose your Bitcoin, right? And Bitcoin's had a long history of this practice, and it takes in different forms, right? Because at first, maybe it was use a computer that's offline or save multiple backups, right? Just have multiple backups of your keys in case something goes wrong. You don't want a single point of failure. The next probably step would be having all of your keys never touching the internet, however you execute that, whether it's a computer that's offline or a hardware wallet, right? Thinking about it that way. And then you start thinking about ways of distributing risk of a multi-signature, right? You have a single signature, you go to a multi-signature, you're further kind of unbundling single points of failure, and maybe you use different hardware wallets for each key, right? So now you're kind of distributing risk across all of these different technical stacks that kind of do the handling of transaction data, the keys, and the signing of transactions. All of this is in the bucket of risk mitigation and risk distribution. The one in the umbrella of risk management, the one thing that's been really missing up to this point is risk transference, which is insurance. And with that, looking at the larger ecosystem, if you look at the larger custodians and exchanges, the ETFs and everything, there is a massively underserved market where Coinbase has hundreds of billions of dollars of assets under management, and they maybe have a $300 million insurance policy, right? So thinking about it from a market opportunity standpoint, it's something that has not really been fleshed out yet in the maturation of Bitcoin as a financial asset. I think as Bitcoin continues to grow, our thesis, and I think this is just manifestly going to be true, is that there's going to be a more robust insurance market that begins to develop around it, right? Any other asset, fine art, gold, collectibles, anything else would have an insurance market. And the idea ultimately with insurance is that you come to an agreement with someone, and that in the event something goes wrong, they'll be able to step in and indemnify you, right? Repair you for the damages, right? Today, our policy is settled in US dollars. We can get into a long conversation about that, but this presented a unique opportunity for us thinking about how, if we are looking to insure the Bitcoin, how can we make it more robust to loss, damages, theft, right? Ways that you could possibly lose the Bitcoin, because you have an arrangement with an insurer where you're all risk aligned. No one's looking for a loss, right? If everyone's an honest actor, everyone wants everyone to be happy and the coins to be kept safe and secure. So this is where we went to the other side of attacking the problem, not just from a financial contract of insurance, but thinking about technically, how can we improve how Bitcoin is custodied on layer one today to be able to offer that risk distribution and kind of like fail safes and guarantees as much as the tech can enable, right? Of how to actually execute this. And that kind of goes into what we've built with the Trident Vault and leveraging MiniScript and doing more advanced Bitcoin native smart contracts, which pair nicely with insurance. And I'll leave it there because I think there's a lot of places we can take the conversation, whether it's on the insurance side or on the tech side.
Yeah, there's a lot. I mean, you have been long in Bitcoin, as I understood it from previous podcast. So you have probably lived through a lot of innovations and cycles of like how to custody Bitcoin and the Mt. Goxes, the exchanges, the things that go bust. Even in the last like 4.5, 5 years where I was in the space, a lot has happened. And it's so interesting that the insurance is not, as I understood it, this is something completely new. Like insurance is basically like this last year developing. What I heard from Chris, like that's something that is just now developing, right?
Yeah, absolutely. So insurance has existed for some time. Actually, someone recently linked me when Andreas Antonopoulos went on Joe Rogan in 2014. I forget the red band, the guy who was on with Joe that was interviewing Andreas, and they're talking, and the guy asks like, "Hey, can you like insure Bitcoin?" And sure enough, if you remember, so I got into Bitcoin in 2013, at the end of 2013. If you know, like the Cashasis coins. In 2014, Lloyd's of London was offering insurance on those Cashasis coins. And Andreas talks about it in that podcast. But right, think about this mentally, though. This was much more directly akin to a bar of gold. I have a coin. It has information on it. It needs to be safe and not destroyed. So you're kind of like locking it away in a traditional vault, right? Because you're still dealing with like a physical token. When you're thinking about larger like insurance, over the years, what you would typically get is at custodians, you would get an insurance policy, which would be crime, the bucket of crime, right? So when you think about insurance, there's many different kinds of insurance. There's homeowners insurance, there's car insurance, there's life insurance, there's health insurance, right? There's many different buckets of things. Most of the insurance coverage that's existed up to this point when it involves Bitcoin is crime insurance. And what that means is that, okay, I leave my money at an exchange. In the event they do some sort of internal theft and crime, I want to make sure that I can pay out my customers. Typically, how this works is it's usually the hot wallets that get insured because those are the ones that are most actively touched and managed. But even those that extend into the cold wallets, they're narrowly covering a specific thing. Maybe it's like the destruction of the keys being held by the custodian or crime, right? This idea of what we brought to market, I would say, is new and novel in that, one, we are what's called a Lloyd's of London cover holder, meaning we are direct agents of Lloyd's of London in that when we sell you an AnchorWatch insurance policy, it is a Lloyd's of London contract, right? So today we're available in the United States only, working on larger ambitions and expanding globally. But for today, we're live in the United States. If you were to be insured by us, it's a Lloyd's of London policy. Up to this point, this was not readily accessible to the random person walking off the street. We're the first able to offer this to retail, non-commercial entities. We also can use commercial entities. Our policies minimums start at $250,000, and we can actually write up to $100 million of coverage per customer. And this is, from an accessibility standpoint, way more straightforward where you talk to us and we can curate and like build you out your vault and your policy and get that on the road. Whereas before you had to go through many intermediaries and trying to like broker one-off deals. So that's kind of a new innovative thing and what we're kind of offering to that. It really has developed in the past year. I know Chris is working on some stuff as well at BitSurance. Like this is something that in the past year, being able to kind of provide this wrapper more directly has been out there. There have been some predecessors. I know there's a company called CoinCover that had wallet insurance. I think they discontinued that product because they were also offering insurance on coins held at Celsius and FTX, which, as you can imagine, not something from a risk appetite standpoint you want to be underwriting risk for. So when you think about it, there's been versions and forms of this. There's like crypto DeFi versions of like you lock up tokens and then the token, if a loss happens, right? But really, it's something that I think the whole ecosystem has started paying attention to over the past 1 to 2 years. We were kind of a little bit skating to where the puck was going when we started 3 years ago. And ultimately, I just view this as Bitcoin maturing as a financial asset. Ultimately, I view like the biggest risk of the ETFs or even MicroStrategy or any of these large like Bitcoin companies that have a lot of Bitcoin on their balance sheet is not like, oh, the Bitcoin price is going to zero, right? Because that's usually how it's framed. It's like, well, Bitcoin over time, we're all directionally long Bitcoin. We think it's going to go up. So like, there's no, like that's not a problem here. the biggest risk is that the coins go missing, right? They get lost, they get stolen, whatever have you. And if you look at the ecosystem today, all of the ETFs primarily are using Coinbase. I believe, so one, Fidelity, the ETF at Fidelity is managed by their own team, right? So anyone who's getting ETF exposure, I recommend at least throwing some in Fidelity because it's at least an uncorrelated risk to it being held at Coinbase. It's a different team. I think BitGo has one of them. There's a couple, like a small long tail, but most of the aggregation risk for all of these financial products are sitting at Coinbase, whether those are the retail wallets, Coinbase Institutional, the ETFs, and there isn't incremental insurance coverage, to my knowledge, on top of any of those, right? And so if you're paying management fees, you're paying fees to be able to secure Bitcoin when you're using these institutions. To us at AnchorWatch, it just makes sense to have a risk-aligned relationship where you're paying for something that if something were to go wrong, you still have your exposure, like you still have your wealth at the end of the day, as opposed to maybe becoming an unsecured creditor or having uncertainty in how incidents would get unwound and what percent you would get back. Like you want to avoid those incidents like FTX where they made 100% back, but it was denominated in dollars at like the cycle low of $16,000 Bitcoin. So they ended up like marking it. It was like, a 20% something recovery for the actual value at the time the loss happened. I just think insurance is just a very natural market fit for working with intermediaries and also just like long-term asset wealth and management, right? Insurance typically is something that people who have wealth get because they're trying to protect their wealth, right? They're trying to make sure that if something were to go wrong, I want to make sure that I have a certain amount of wealth at the end of the day. And just honestly, it goes to kind of like the maturation of the ecosystem that we're just getting to a point now where people are starting to consider that longer time horizon of making sure that they can keep that Bitcoin safe and be protected against many risks.
Super interesting. And if you insure something, you probably also have like, okay, this is how the custody setup should look like. Like you probably have like a checklist. Where it's interesting, you also train kind of the client of like, this is the security standard, or this is where we want to do you have like a checklist and like, okay, you have to tick those boxes?
Yeah, so there's specific, they're called insured like duties, like your responsibilities in entering the contract. The first thing is if today our flagship product, as we call it, you're using Trident Vault, which is our kind of custody technology stack that we built out, which is leveraging these more advanced Bitcoin native smart contracts. Just at a very high level, what that means is that we're using Bitcoin as programmable money, and we're able to do things that other providers in the market have not done yet. These are operations that don't require a soft fork or any changes today. And there's a couple key premises here. One, we leverage multi-sigs of multi-sigs. So actually for the length of your insurance contract, AnchorWatch is a required cosigner. It's an interesting concept too, because at no point ever can the money be moved by AnchorWatch by ourselves. Right. And so that's an interesting concept of what we like to call negative control. So at a very high level, just to walk. And then the second thing we use is time locks. And I'll get into that now. So at the start of your policy, you have a vault, which is a 2 of 3 multi-sig and a 2 of 3 multi-sig. The first 2 of 3 is managed by AnchorWatch. The second 2 of 3 is managed by you, the customer. That means that both of us have to sign on the transaction. And you can think immediately, this does a lot of interesting mitigations of risk, right? If someone broke into your house, like got into, your keys have to be stored in safety deposit boxes or actual vaults, right? Like safes, physical ones. And because of that, you're in a dynamic where if you were just doing a 2 of 3 multi-sig, if the attackers get the keys, your keys, then that means that Bitcoin's moving. With us, we have to also co-sign the transaction before money can move, which allows us to be able to kind of slow things down in the protection of your interest and making sure, is this an agreed upon withdrawal, right? We're able to institute 2 different kind of concepts of one, enforcing a whitelist, right? Making sure that it's a pre-approved address that you already like authorize and sign off. I want to send Bitcoin to this address. And then additionally, we're also able to have things like velocity controls. So hypothetically, this is actually an interesting point too, as it interrelates with the risk of the policy, is that many of our customers are opting into what's called the HODL discount, meaning, hey, this is my deep cold storage. I'm not going to touch it all year. I don't want to spend it at all. And because of that, we're able to evaluate and say, hey, the risk is materially lowered if they're not regularly transacting with the vault. And we're able to offer better pricing because of that, right? Because there's lower risk, right? So you can start seeing how us in the insurance role are able to actually incentivize behaviors that are risk aligned. Saying if you are going to engage in lower risk activities, we can offer you cheaper coverage. Because of this, like now, like that's that first layer, right? The 2 of 3 from the customer and the 2 of 3 from AnchorWatch. 6 months into the policy, you're actually in a position where we leverage time locks to say, you know what, maybe if you've lost 2 of your keys for whatever reason, it's only 1 of your keys as the customer, as well as a 2 of 3 from us at AnchorWatch. Now, this provides you some more flexibility in just being able to know that, hey, if I have 1 of my keys accessible, I can still move funds 6 months in. Now, the next step is at month 11, roughly, basically when you're getting towards the end of the policy, there is a window where you're still insured, where it actually goes to, in the event you lost all of your keys, right? Home fires, disasters, thefts, robberies, what have you, it goes to an AnchorWatch 2 of 3, as well as we use our recovery partner, Coin Corner, based out of the Isle of Man. They've been in business for 10 years as a Bitcoin-only exchange. I'm sure many of your audience knows them. They can also have a key to be able to move the funds. And this allows us to, again, AnchorWatch can't unilaterally spend the funds. And additionally, multi-jurisdictional, right? They're based over in the Isle of Man, and we're able to act in the event that something were to go wrong. We can still help you recover your funds, which is kind of fundamentally different than how other arrangements work today, where maybe a partner has a minority of keys and you still need to have some key material. This additionally is really interesting because we've gotten a lot of initial feedback on this is a really handy inheritance protocol, where if your heirs, your beneficiaries, don't have to have Bitcoin knowledge and they don't have to manage key material to be able to return funds to you, right? So this is like a fundamental difference in how other recovery systems work today. Final step, though, is that after the insurance policy expires, we don't have a contractual relationship with you anymore. It goes to your sole 2 of 3 custody, right? Which is a different dynamic than working with a custodian, where maybe you have a 1-year contract, the contract ends, and you're like, hey, can I please get my Bitcoin back? You have to ask them to get it back. Whereas in this, the default state, it goes back to your sole unilateral control. And this is all done on-chain, leveraging, as I mentioned earlier before, MiniScript, which came out of Blockstream in 2019 from Peter Will, Andrew Polstra, and Sanket Gandhar. Like that team put this together, and it. We don't have to go into the technical details unless you wish. It's a very clean, safe way to be able to do these more arbitrary ways of securing your Bitcoin in a safe manner.
Yeah, I think the MiniScripts are something that not too many are actually aware of that. I mean, it's getting, I see it more and more developed, and I see it more and more discussed about, but it's actually something that I also just got aware of, I think 6 months ago or something like that, where I first had my touch point with MiniScripts. So it is definitely something that we should talk a little bit about.
Sure.
Maybe not too deep in technical details, but give us some overview of what MiniScripts are and how they can be leveraged.
Yeah. Absolutely. So I would even just take a super step back, right? Because we are using MiniScript for our use case and application. But let's just super zoom out to the general audience here. Bitcoin, and one of the strengths that many of the proponents of Bitcoin believe is that it's very narrow in what it can do, right? It doesn't do arbitrary smart contracts that are Turing complete. Because of this, there is a very set few things that can be done in Bitcoin. Now, typically, up to this point, we have gravitated as an industry towards either single signature or multi-signature. Another example of something that's different would be like a Lightning channel, like a Bolt 3, like the actual way that the smart contract on chain is a 2 of 2 that falls back, and then you can do a justice transaction, all of that. There's a lot of technical overhead when it comes to this, right? You have to think about, okay, I need to be able to know what the format is. I need to have it be reliable. I want to make sure the only way I can spend it is the way I'm intending it can be spent, right? If you yourself, Bitcoin script is a full programming language of itself. It may be not Turing complete, but you can do many things in there, right? I think there's 150 or so opcodes that can do different things. And you could just write a program yourself. I want to do op if this, else that, right? And then, but one of the immediate problems is are you sure the way that you coded that is the only way you can spend it? Right? If you're just like casually like at a computer, like you set up an address and you like set up your contract, there's no refund. So if you deposit money, maybe the first problem is, oh no, did I set this up in a way that it actually can't be spent? And I just sent Bitcoin in there, it's locked forever. That's totally a possibility, right? Other ones are being, hey, I coded it up this way, but a miner can actually rearrange how I'm broadcasting the transaction and steal the money from me, right? There's all of these like contingencies and corner cases that get really prickly and thorny, and when you're trying to actually do it. Additionally, when it's time to broadcast the transaction, you have to actually arrange the script in such a way where you're providing the signatures in the right order and stuff. And that gets a little complicated. What MiniScript does, it allows I call it bowling with bumpers, where you can't throw a gutter ball. Like if you program it, as long as you have the key material that you're supposed to have, you're able to kind of execute and spend the money. And this is a really helpful way for also hardware wallets to be able to arbitrarily interface with these more advanced spending policies to be able to provide signatures and verify, yes, I'm sending the funds in the way I intend them to. It's in that sense, I would say a really broad canvas for people to start thinking about how you can use this. Here's a really simple example on how you could leverage MiniScript. You as an individual, let's say you have a 2 of 3 multisig. You may want to have and say, if the money has not moved in a year, maybe make it a 1 of 3 multisig, or maybe make it a 2 of 4. You could have a buddy who on the normal day-to-day operations of the vault can't do anything with the Bitcoin, but they can come step in and co-sign with you as a fallback contingency. A really great project that's kind of like fleshed this out is Liana Wallet over at Wizard Sardine, those guys. It's a really handy way of starting to think about using these tools in a self-sovereign way. You can run the software. It's free open source on your own node. And it provides a lot of flexibility in many different ways you can spend the Bitcoin. Other ones that this goes into a conversation too about time locks. I think the idea of adding time locks to your Bitcoin security is a massive improvement to what we have today, because with time locks, you can actually have contingencies baked into how the money can be spent. And that gives you more flexibility and more disaster recovery, right? Because the way Bitcoin works is you kind of set up your rules, you deposit the money, and then it sits there. You can have many different ways you can spend that Bitcoin over the course of time, which gives you risk mitigation, risk distribution, contingencies, right? You don't have all of your eggs in your 2 of 3 basket. And these are just really just powerful concepts when you're thinking about how you want to be able to spend your money across time that give you, even on just today for like a self-sovereign user, a lot more governance, like control and confidence in understanding that they have many different ways that they can make sure their Bitcoin is safe at the end of the day.
I think it's an amazing thing of like, hey, like if I didn't move my Bitcoin for a certain period of time, there's a key unlocked and I can still do it in case I lose some of my keys. And hopefully with that, also the stories of like, oh, I lost my keys and now I don't have access to my Bitcoin get less and less over time, because there were a lot of stories like a few years ago, and I hope in a few years we have less and less of those stories.
Exactly. Right. And that's why we attack it like the way we're using it for this risk distribution, right? Reducing the ways that you could possibly lose the coins, even having contingencies of in the event everything is lost for you as the customer that we're still able to recover. I think this is just a really robust design space of being able to offer support, right? And over the past 2 years, we've had many of the hardware wallets. You have the Ledger, you have the Cold Card, the BitBox 02, the Spectre DIY, the Blockstream Jade. They're all kind of coming to step in and like be able to provide that infrastructure, because that was kind of part of the last mile friction in understanding like, okay, technically I can run this on my command line and I can do a couple things, but like, how can I actually have my traditional signing experience that I'm used to and comfortable with to be able to run with this? So I think it's a really great improvement, and it's really interesting in that it doesn't require a fork at all, right? This is just using Bitcoin as it exists today. That's kind of the hat I wear as an entrepreneur of, there may be things I want to change Bitcoin in the future. Like there are features like vaulting, being able to restrict outputs so that I can kind of do my own native velocity controls and all that stuff. But I'm building a company today, and I'm not going to build my company on the assumption that I'm going to get something in the future. So I think this is just a really ripe design space for not just myself, but anyone who's thinking about building applications in Bitcoin. I think there is a massive amount of opportunity for being able to build in this. And the way I view this too is that Bitcoin as programmable money, the more that we leverage those native programmable functions, we're going to be able to build better financial applications across the board. And it's a really interesting way of being able to think about how you can provide values to customers by kind of having ways that maybe they can still be self-sovereign. You're not dealing with a custodian, and you're able to kind of improve that, just the ultimate, like that store of value use case. Because this is a layer one solution. It doesn't unlock inherently new layer two scaling technologies on its own. But for me, and kind of what I chose to tackle within starting this company was that store of value, long-term holding use case. And this just seems to be, it's very apparent to me, a very great way of being able to offer more to kind of service that use case today that really has not been explored up to this point in the larger industry.
It's an interesting point that you brought up a minute ago with like changes to the Bitcoin protocol. What are, because you have seen already so much in the past couple of years, what do you think are the changes that we have to do or should come to the Bitcoin protocol in the coming years?
Yeah, so the lens I view this through is, and there's many different cohorts in Bitcoin that have all different things they want to work on, right? My main focus is layer one security, right? And there's kind of a spectrum of like small baby steps and kind of like a grander vision to start. I think looking at something like CTV, being able to restrict outputs and being able to do kind of vault schemes with that is a great way to start. And being able to say, hey, once it's in this vault, I only can send it to this address, maybe have a time lock against it. And it kind of gives you like an intermediary staging area before funds can go out to the larger ecosystem. With this too, I think there's been some conversation recently around CTV and checksig from Stack. Checksig from Stack allows you to do kinds of like key delegation. I was watching some post yesterday with checksig from Stack. Jeremy Rubin was talking about how you could actually prove that a key only signs once and it won't sign again. Like you can do interesting security models and trade-offs as it relates to that. I think that's like a small step in the sense that the code has been around for 5 years. There hasn't really been a bug or an issue found yet. I think there's a large 5-coin Bitcoin bounty for anyone to find a bug in it. It's been sitting there. I think that's a good initial step. If we're talking like the grander vision of what I would love to see, I'd love to be able to do 64-bit math. And the reason why is that you actually could start doing core velocity controls of how much with transaction introspection, like looking at the details of what you're sending. I could say like, hey, if I'm sending over a Bitcoin, you have this security arrangement. If I'm sending less than a Bitcoin, it's this lower security threshold. And start thinking about all of these products and services that companies offer today for helping secure your coins with whitelists and velocity controls and how much you can spend. You could, in theory, bring that to a state where it exists on chain, right? Talking to NVK from CoinKine, he's like, I just want to get to a point where you don't even need the cold card anymore, right? I want to obsolete myself out of business. I want all of the security and all of the ways that you can kind of control and manage your funds with an HSM. And I just want to have that sit on chain. Those transactions would be larger. That's kind of a much more further out, ambiguous, larger goal. But I think there's small incremental steps that we can take between now and then to be able to kind of incrementally improve that security, like an op vault construction, where I was just having a conversation this morning with Matt Corallo and James O'Byrne on Twitter. The way Bitcoin works today, it's entirely proactive security, right? You set up the way on how the money can be spent, and then you kind of you have your drawbridge and your moat, and you have your all of your defenses. But if someone gets through that and they send the Bitcoin out, you have one block to be able to try and send it somewhere else, and then otherwise you're just done. That's worked really well up to this point. I would love to have reactive security, where after a funds get broadcasted, you have a window and opportunity to be able to pull those funds back. So you go from I have less than a block to try and fix this issue to maybe I have hundreds or thousands of blocks on the orders of days or weeks, where I can have deep cold storage and say, okay, I'm going to do a withdrawal, but it's not going to be able to go out of the vault entirely until 2 weeks have gone by. And that allows an opportunity for me to realize, oh no, something has happened. Let me try and pull those funds back. You have to manage a different set of keys to be able to do that, to be clear. All layer one Bitcoin security assumptions, though, are that your private keys are kept private. I would love, though, to be able to take that window of you have less than a block to you have hundreds, if not thousands of blocks to be able to institute a recovery.
Let's take a break for a moment and appreciate the beauty that Coin Vigilante has made with the Bitcoin watches. Those watches are the most amazing, the most elegant way of showing that you are a true Bitcoiner. And Coin Vigilante just dropped a completely new and amazing Genesis edition of their watch collections. You have the date of the first ever mined Bitcoin block in there, and of course also the block height and which epoch we are currently in. I love the level of detail they put in this masterpiece. Make sure to check out those amazing Coin Vigilante timepieces down in the descriptions. I love those watches so much. And now if you have Bitcoin, I really do hope that you don't have it on exchange. But if you do have it on exchange, I have two ways for you to deal with that. The first way is you put it on a hardware wallet. That's the entry for you to get into the self-custody game. I recommend BitBox, Bitcoin only edition for that. It's a super simple and secure way. And if you check out the link in the description, you even get 5% off if you use the code Robin. And the second way is the Bitcoin Way. The Bitcoin Way is your all-in partner in terms of how to get the most out of your sovereignty. They will personalize for you a self-custody setup that is perfect for your individual situation. They will show you how you can secure your own devices. Securing your Bitcoin is not enough. You also have to keep all your devices secure. One topic that is overlooked often is the inheritance plan. What happens with your Bitcoin once you are no longer here? Do you have a plan for that in place already? And last but not least, if you're in a jurisdictions where you don't feel safe, it's better to get a plan B. For all that, head over to thebitcoinway.com/Robin to get a 30-minute free call. And just a quick side note, I will be for the first time ever speaking at the Bitcoin Prague event in June. It will be absolutely legendary and I'm really looking forward to seeing all of you there. You can get your ticket in the link down in the description of Bitcoin Prague, and very important, use code Robin to get 10% off your ticket. I'm really looking forward seeing you there. It's also an interesting conversation of like, now we are a small group of people. We are basically in a very early stage of a very early revolution. How will this look if we have all of a sudden 4 or 5 billion people wanting to interact with Bitcoin?
Sure.
How do you imagine that? It's probably most not on chain. I guess like the most applications will be something above Bitcoin.
Yeah. So this goes, I would say, one step outside of my passion and my deeper intimate knowledge when it talks about scaling. But you're going to, in this world, I think ultimately you cannot have 5 billion people interact with Bitcoin on layer one. It's a non-starter, right? That's just the nature of the size of the block space and the UTXO set, just the natural forcing function of scarcity of the Bitcoin blocks themselves, that you can't achieve that. So then you get into different models where you have different protocols that kind of act on top of layer one to be able to do this. I think an example of what's working on this today is Arc, right? The idea that you can kind of have a virtual UTXO that gets shared within a pool of people. And then on occasion, if you have a large enough balance, you're going to be able to sovereignly withdraw. At no point ever, if I have 100 sats, is it ever going to make sense for me to unilaterally withdraw to layer one, because you're going to blow the dust limit, right? And you're going to have to pay transaction fees when you claw it out of a system to be able to move it again on your own. So there's going to be a natural floor that's going to be a combination of, I would say, basically the block space, right? At 0 sats, at 1 sat per vbyte right now, you have a lot of ability where it's only maybe a couple hundred sats to move a single signature transaction. In this world where we're thinking that more and more people, we're talking billions of people interacting, that those fee rates are going to be 2, if not, eventually 3 orders of magnitude higher, right? You're talking like hundreds of sats per vbyte, like we saw during a couple spikes last year while people were doing a lot of layer one speculation. Designing these systems to be able to support that is going to come with just natural trade-offs for layer one security, in that not everyone's going to have layer one. So how can you design systems at layer 2 to be able to kind of distribute. It's less so distributing the risk, but making sure that you can have natural game theory and kind of evolution of these like layer 2 solutions that are going to be able to protect users at the end of the day, right? It's something that, like I said before, is not my core area of focus and expertise. So it's definitely not something that I'm going to have a more prescriptive model of how that gets accomplished. I would say, though, that that's naturally the course of Bitcoin as it kind of permeates the global financial system in the world for payments.
Yeah, it's really interesting, this question of like scaling Bitcoin. It's also like, it's so fun to watch the adoption moving forward in life. I just had 2 days ago or 3 days ago a conversation with someone that came into Bitcoin, I think 2013 or 14, and he told the story of how he first bought Bitcoin. He literally had to go to someone locally and he felt like a drug dealer because he was dealing with someone that he never know, like, and it felt illegal at that point. And now we have come so far with like ETFs, with the exchanges, with all those great services and products around it. And now, I mean, maybe tomorrow for the viewers that I listen to this, probably like 1-2 weeks old already, the strategic Bitcoin reserve and nations buying it. It's kind of unbelievable where we are. How do you look at the speed of the adoption that we're currently witnessing? Are you kind of surprised of how fast things are actually moving?
Yeah, it's interesting in the sense of like, I mean, there's that line we like to use, gradually then suddenly, right? Because, you know, when 2017, I thought it was inevitably like, this is now, it's happening, we've arrived. We've definitely gone up a tier in kind of the level of, in the attention economy, in global politics, in macro economy, like, you know, the focus of Bitcoin specifically. It's, to me, I think this is just part of natural hyper Bitcoinization, right? More and more people are paying attention to it. More people are interested in it. I think over time too, what's really interesting we're seeing is that Bitcoin dominance is also accreting to, like, I think we're over 60% at the moment. The larger ecosystem is also starting to be able to disambiguate and understand Bitcoin is something special. I'm not, if you saw Jesse Powell from Kraken, Brian Armstrong from Coinbase, and I forgot the third, but like 3 US exchanges were basically saying, yeah, it should be a Bitcoin only reserve. And it's funny because everyone's like, oh, look at this. Like, all of these companies that list all these other coins are talking about, you know, it all has to be Bitcoin only. I think they understand, right? And the reason why they understand is that if they're at the adult table, right, you're talking with world leaders, the last thing they want to do is have them, as the proprietors of the exchanges, have them be bag holders for these random coins. They know that Bitcoin in the long run is going to accrue value, right? They have extremely high confidence and their business is built on that. Most of their revenue, though, is happening because of the buy and sell of all of these other coins, right? Or you have maybe like a Coinbase where they now have a layer 2 of base, right? So they're trying to collect the transaction fees for kind of like this larger crypto economy. They don't have as much confidence in the long-term accrual value of that, right? The way I view it is like they all have casinos and they collect a good rake when you do that. It's funny, I have to think about that casino metaphor more because I used to play a lot of poker. And the thing with poker is that you're playing against other people. You're not playing against the house. So the house just takes a small little fee and they kind of just go about running their business. Whereas if you go out and play slots, there's a massive edge where you're just dumping money into the house that's running the casino. They know that Bitcoin's going to be the long-term winner. So they know that if they're getting the adults sitting at the table, they want those guys to be really happy in the long run over the course of like a decade or two that they made the right decision, which would in turn kind of give them more political prestige and power. And they're not going to get that if they have the random long tail of all these small coins that are in there that are going to be down. And so I think it's effective branding. I think it's total on the narrative, the mimetic narrative wars capitulation that Bitcoin is a de facto store of value. You can just look at the ETH BTC trading pair over the past couple of years, right? And the increasing Bitcoin dominance. It's exciting times. I think like a lot of things that we were saying in our little corner of Bitcoiners that were seen as heterodox to the whole like crypto industry. We've had years and years of playing these narratives out at this point, and over time, our thesis is being shown to be correct.
That's an interesting perspective of like the game theory of people that understand Bitcoin and crypto, they also understand that if they say now, oh, like we have to do those shit coins, and if president actually acting on that and they go to shit, it falls back on them. So they don't want to recommend anything else than Bitcoin because they can rely on the value of Bitcoin. I never thought about that actually. It's an interesting game theory aspect of casino leaders.
Yeah, because like they're making money on Dogecoin because Dogecoin's not going up. It's because people are buying and selling Dogecoin all the time, speculating. But a strategic reserve is a long-term held asset. So the exchanges don't even have an opportunity to make money as it relates to buying and selling, because it's not like you're going to have a daily like portfolio manager who's like longing one and shorting the other. It's supposed to sit there and do nothing, right? Which is Bitcoin's superpower, is sitting there and doing nothing. So you have a total different divergence where their retail-facing business and kind of their enterprise-facing business is getting people to speculate. For a long-term held asset, the performance metric is, does the price go up over time? And for everything else, the answer is no. Right? You have volatility and spikes and up and down, but they're long. And if you zoom out, it's down and to the right on the price charts for all of those. Whereas Bitcoin is up and to the right. It just makes sense there for sure.
What does the ETF paired with, like the ETF second year paired with a possible strategic Bitcoin reserve now mean for how close we are to this hyper Bitcoinization, this suddenly moment that you said before?
I still if you ask me, I still think we're a decade out at least. This is Bitcoin is a $2 trillion asset right now. That's a puddle in the ocean of global capital markets. It's still so early, and we can have a 10x and still be on the early side of that conversation, right? So for me, this is just kind of climbing, like basically Bitcoin gets promoted and gets to sit at a larger and larger table. And this is just the beginning of that. It's the beginning of the next stage of the game. The next level of the game is just starting. And it's going to take a longer time horizon for it to all play out. I think it's validation of the thesis, and that if you were having this conversation, in 2017, you said you've been around Bitcoin for 5 years. If 5 years ago you got in, you're like, oh, in 5 years, you're going to have world governments that are going to be coming in and buying Bitcoin and thinking about that, and they'll be accessible to all traders in the world through stock wrappers. You'd be like, wow, that's amazing. Like, that's huge progress, right? So like, we're just validating like the next step that our thesis 5 years ago is we're on the trajectory of being more right than wrong. So we're going to have to do another round or two of this. It's going to take time still. I don't think it's happening tomorrow. If it is, I'm ready for it. But I think it's just going to naturally, we're going to keep riding volatility, and we're going to keep on climbing and growing. And it's going to be really exciting kind of seeing how this next level plays out.
I do agree with that a lot, and I see it like that. And that's why it actually surprises me so much that the USA is now moving in. Like, I expected, when I think about the nation's game theory, El Salvador was kind of expected, that like a country like that tries things out like that, and then maybe like a smaller country like Bhutan is basically doing that. They have for their size of their country a massive amount of Bitcoin if you compare the size of the country with how many Bitcoin they have. Mm-hmm. But America is just surprising me so much of like why are they moving? They have known. I mean, they have the biggest fiat bag to secure, but they have. I thought they will be at the end of the adoption cycle and not at the beginning of the adoption cycle.
Well, it's funny, right? I'm an American, right? I would say a proud American. I think many of the great things about America are, it's free and open markets. And I actually think I tweeted this the other day, the strategic Bitcoin reserve is not the US government holding it. It's families holding it, right? It's businesses holding it, right? And from a capital market perspective, it is interesting to see that the US is trying to like lead the way on this, where you would have thought they'd be at the end because they have the most to lose with the losing of the petrodollar and the global dollar as like the world reserve currency. I think the problem with that is, unless we get an act of Congress, the next administration can come in and undo everything that's being done right now, right? So you very well could have some strategic Bitcoin reserve set up, and then in 4 years it's being unwound. And that's why I think in the long run, the actual strategic Bitcoin reserve are the people, the individuals, the businesses, capital allocators who are holding in Bitcoin. They've held Bitcoin for a very long time, and they're not looking to sell anytime soon. I think it's interesting, and I think this actually goes to a bit of the natural disruptive nature of America, the culture of America, right? Where you have Elon Musk, you have David Sachs, you have all these like serial entrepreneurs that are now kind of like in the administration. They're trying to move fast and break things and try and disrupt themselves. This is like the innovator's dilemma. The idea that if you're like the market leader, it's harder for you to be able to come in and figure out the next new thing because you're incentivized in the way your corporation operates to not kind of really ultimately break the mold. But the flip side of that coin in American dynamism is that you have all these startups and you have all of these companies and people that are thinking about how do we kind of attack the incumbents in a way that we can provide more value to end users. And you can just do that as Bitcoin. Bitcoin is a better value proposition to the end users that are actually holding currencies for the long run. And so with that, like, I think it's interesting to see that the US is dabbling in there. I'm going to have medium to low confidence until it's an actual act of Congress. And that's just the nature of just how America and our judicial and our legal system and the whole process of our constitution and how laws actually get created. If you want something to be sticky, you need Congress to actually be there, because anything that a president unilaterally does, the next one can just unilaterally undo.
Yeah, it's also interesting, the concept of like grassroots adoption versus institutional and government adoption, where you as a Bitcoiner, you actually want the families of America to hold as many Bitcoin as possible, and not the government. Again, that's like I'm way more happy if someone in the family adopts Bitcoin than the government adopting it and holding it in kind of like for the citizen. Like that's an almost an anti-Bitcoin thing.
Yeah, it's like I said, it's part of that culture just in America of the cowboy, the entrepreneur, the businessman, like whatever you want to say. Like, what I also love about that too, just thinking about it from the risk side, it's distribution of risk. All the coins aren't sitting in one place, right? Distribution of keys is good for the health of the network.
Absolutely. I have an interesting question that I recently got myself, and I was like, I want to bring it into a podcast, and I think maybe with you, it's a perfect guest. If Satoshi returned today, what do you think he would critique the most about Bitcoin?
If Satoshi were to come back today, what would be his biggest critique? It's a hard question to answer, because I think anyone who would answer this question would basically be smuggling their own opinion into the answer and be like, well, Satoshi would agree with me, obviously. Right. So like the question's a hard one to try and answer, honestly. Like, I never spoke to Satoshi. I read his email posts and stuff. It's hard for me to have a read on what his thoughts were. It's a really tough question. And now that I've kind of revealed the thought process of trying to not smuggle my own opinion into what I think Satoshi would say, I think if I were to say in the evaluation of Bitcoin, I think just being more open-minded to how other people are using it, right? When he disabled a bunch of opcodes back in 2011, right before he left the project, he was concerned not of people using Bitcoin for use cases that everyone wouldn't agree on, but it was a concern of it would literally crash the network, right? It's hard to say too, because Satoshi had such limited information when he was a steward of the project, right? In 2011, when he left, like, mining pools were like not really a thing. Like centrals, like it was still mostly like CPU and it was GPU miners, right? That's why he actually chides Laszlo for doing the GPU mining at first, and I think this is actually, if I were to speculate, like probably Satoshi had some familiarity with hardware. He probably understood that you could use a GPU to kind of mine faster, but it was good for the health of the network if any random computer could get turned on and mine Bitcoin. And so because of that, he kind of chides Laszlo for kind of opening up Pandora's box. And then you kind of go down the route of ASICs and mining pools and this kind of concentration. And maybe that's actually a safe one. Kind of the stuff that people are doing at Ocean for being able to disambiguate between mining pools and the actual person who creates the block template. It's good for the network that you don't have like basically nine entities that pick blocks, maybe less if you look at how they're aggregating under the hood. I think that's a good one. I think that's actually a really good safe one that he would want to have more, because that's something that is a market dynamic that evolved after he left. He would probably want to have a strong critique on the fact that we need to have more distribution in who's proposing block templates for the mining pools. Yeah, like Stratum V2 stuff. I think that's actually a really safe one that isn't really kind of talking my own perspective in POV, and something that developed entirely after he left would be that organization of block propagation.
Yeah, probably like the all the things that go in the direction of like, let's make this thing more decentralized, more robust, and that's is a really good one. Like the ocean topic comes up, I think, in the last couple of months more and more in the podcast. I really like it. We have one question that I ask each and every one of my guests, and the question is, what can we learn from you besides Bitcoin?
What could you learn from me besides Bitcoin? Interesting. I have some fun answers. I'm trying to think through a couple of them. I mean, learn as if like you and I spent a couple hours together. We learn, or like a lesson or something that isn't just Bitcoin. Like
I usually
is it like if we sat down for 6 hours, I could teach you something, or is it like a parting thought of something you can learn that isn't related to Bitcoin?
It's interesting because those are the two things you could go down, and I see guests answering in both directions. But my original intention was more of like and skill and something like an area where like what are you also passionate about outside of Bitcoin is probably like a different way to say it.
So I have a couple. I'll list off like I've been working a lot with. I was previously a data scientist and a programmer before getting into Bitcoin full time. So understanding how to like architect big cloud enterprise systems, being able to do data analysis, automating tasks. But maybe a fun one I'll just go for is I'd teach you how to count cards. It's actually not that hard. I used to, my favorite professor math professor in college was part of the MIT card counting team. So I'd go to his office hours, and it's actually very simple arithmetic of plus and minus. But the actual fun for me, whenever I was doing it, wasn't the mathematical, like I'm going to make money. It was the social game you had to play to not draw attention to yourself, and understanding how to behave in a controlled environment to not come off as someone who's trying to count cards. And that's a fun activity that you could probably, with a couple $1,000s, you could make some positive EV bets and come out with a little bit before you get put into a database. It's it's just like one of those fun things.
Yeah, it's. I also love. I never talked about that on my podcast, but I actually love doing small magic tricks. Nice. Just like learning a small card trick to see if we can do, because it's mostly just about not bringing attention to the small trick that you do within like a 5-minute presentation. So people are like, how he actually did that, because there's always like some small thing that you have to do, like a double lift or something like that. So I do like that a lot outside of Bitcoin. And it's actually, someone asked me recently, what would you do if you couldn't talk about Bitcoin? I was like, AI sounds interesting, but maybe I just go down a fun rabbit hole of magic tricks and open my YouTube channel on that.
Nice. Yeah. That's really great.
I've one more question because of data science. What are the metrics that you're looking into when you look at Bitcoin? Of like, are you looking at the hash rate? Are you looking at some metrics of Bitcoin regular to see where Bitcoin is going?
No, I don't actually. It's funny enough, with my background, I don't look too much at the on-chain analytics of things. I think the most interesting ones, just matter of factly, are like the HODL waves that the Unchained team puts out, are just very clear, concrete, observable patterns on how the velocity of coins and how long people are holding them for. I think it's a great visual too, to be able to tell a story. That's a great one that I can be able to show. And it's also, the nature of it requires a lot of time, as opposed to like, oh, hash rate's up, hash rate's down, coins are moving to and from exchanges. Like, it's kind of like this chaotic frenzy all the time. Getting a larger sample size, reducing variance, and seeing the long-term trends, I think, are more interesting. So like the HODL wave stuff for sure.
Really cool. I do like that also. I think the last time I talked with Checkmate, that was the on-chain stuff is really fascinating, but it's also not my world.
Totally.
But I thought maybe you're into it because of the data science background.
No, yeah.
Really cool. We have one last end routine in the podcast where the previous guest is asking a question for the next guest without knowing who the next guest actually is.
Okay.
We touched on it today already, but what is the most exciting thing about Lightning?
Most exciting thing about Lightning, for me, I think what I love about Lightning is that they can't, like the Bitcoin community came together to leverage Bitcoin script into a way that you can do a new scaling solution, right? Lightning got 3 soft forks to get enabled. It got 2 time lock opcodes that were across 2014, 2015, and it got SegWit in 2017. And I think it's a really powerful use case of showing that when the community comes together and understanding different use cases, that you can actually enable whole new design paradigms on how Bitcoin can function with that was not part of the original vision, right? You can kind of like over time kind of expand the perception of what's possible. And I think Lightning up to this point is the best possible use case for that. I also love that it's anonymous payments for the sender. I think it's a great way to be able to do instant settlement. Going to Bitcoin Park and buying my seltzer every day and just like throwing 1,000 sats into the BTC Pay terminal. Like it's an amazing experience. Like I'm using Bitcoin all the time, and it lowers that friction to be able to kind of spend with it.
Absolutely. Thank you so much, Rob, for being on the show. Before I let you go, where can people find you, ask you questions, and reach out to you?
Absolutely, yeah. My Twitter handle is Rob1Ham, ROB1HAM. You can reach me at rob@anchorwatch.com. Check out anchorwatch.com if you want to get signed up for our email list, if you want to like learn more about what we're doing. Yeah, that'd be great.
Thank you so much for being on the show. Also, thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back tomorrow with another episode. Bye-bye.